Hello, Singapore. Very happy to be here to share with you JP Morgan's outlook on the bond markets. So, this is the first time I've done a FSM1 event. And I have to say, I'm very impressed with the setup. I also quite like the theme of the conference, which is nostalgia. Now, you know who I'm nostalgic about? I'm nostalgic about my hometown hero, Bruce Lee. And the reason is, Bruce Lee, to me, he's a true innovator of the martial arts. And he explained his philosophy in a very famous quote. He said, "Be water, my friend." And what he meant by that was that he felt that the traditional practice of martial arts was a little bit stiff and not nimble enough, because if you were to train in the traditional martial arts, oftentimes they'll emphasize the firmness of your stance, right? So you might be taught to do this horse stance, right, where it's immovable and then you punch from there. But Bruce Lee, he emphasized the fluidity of movement. So instead of the horse stance, more likely, you will likely see him do this more likely. Now, Bruce Lee's martial art was both fluid and firm, dynamic and adaptive, but most importantly, effective. And I bring this up because we at JP Morgan have certainly had to be like water to navigate the very tough markets last year, to outperform the markets. Because you see, last year was the worst year on record for fixed income, for bonds. So what you're looking at here is the calendar year returns of stocks and bonds. The green is equities, stocks. Blue is bonds. Now, most of the time when the green goes down, bonds are supposed to provide that defensive characteristics and stay up. But you can see for the first time in the last few decades, both those lines are down a lot. And so that has made managing a bond portfolio very, very tricky. The risky parts of your portfolio was down. The safe part of your portfolio was also down. So we've really had to be very fluid in how we manage our strategy. So what we're looking at here is our positioning over time in our flagship income strategy. And you can see it really is like water. The black line that you see here is our strategy's interest rate sensitivity. Now, interest rate sensitivity, for those who don't know about bonds, works in reverse with price. When interest rates go up, bond prices go down. And that black line is the interest rate sensitivity of our strategy. The higher that line is, the more sensitivity we have. And I would like to draw there's a lot of information here, but I would like to draw your attention to our recent history on the right-hand side of this chart. And you can see right after COVID, when the Federal Reserve had restarted its money printing machine and did a lot of QE, it pushed US Treasuries to all-time lows, the yields. And so beginning around the second half of 2020, we began shorting US Treasuries. Those are what the blue bars are. And then came 2021. Not only was the Fed printing money, but now they're giving the money to the US government, who in turn was now writing checks to Americans. And we thought that was highly inflationary and would likely end badly, even though the Fed back then was telling us that inflation is likely transitory. Remember that? So instead, we deepened our shorts. So coming into this year, we had like one of our largest US Treasury short position in our strategy, in the history of the strategy. And that had been the key driver of how we outperformed the bond markets in 2022. Now, how did we get it right in that we're shorting treasuries during that particular time? We've come up with this framework to help us understand when do stock-bond correlations break down And when do they go the right way? We call it the 3 phases framework. And clearly, we have just gone through phase 1, the yellow box. That was 2022. Phase 1 is characterized by when the Federal Reserve has just done a lot of QE and is pivoting to QT, quantitative tightening. From printing money, they're sucking money out of the system now. And that causes bonds, stocks, credit, everything goes down at the same time. And that's why the only thing that works is to be short the market. And that's what we did. But the good news for everybody here is that we think phase 2 is what's coming next this year. That's the green box. The green box is characterized by when the Federal Reserve is still tightening, still raising interest rates, and still sucking money out of the system. But the tightening now is finally causing the economy to slow down and to even enter a recession. And so that in that environment, when the economy enters a recession, treasury yields tend to come back down. And so right now, we have once again reduced, we have got rid of the shorts, and now we have positive interest rate sensitivity in our strategy. Now, in this environment, stocks and weaker parts of the credit markets could remain volatile. Volatility could remain high, but we do think that interest rate sensitivity once again can help you dampen down your portfolio volatility. So that was the past, recent past. What's next? Going forward, we expect that the US recession will likely enter a recession by the middle of this year. So at JP Morgan, every quarter, all of our fixed income investment professionals have a full day meeting, all 300 of us, and we debate everything that is going on in the fixed income markets. One of the summary outputs is this chart you see here. So what this is that every quarter, we would assign a probability to each of those 4 scenarios: above trend growth, sub-trend growth, recession, and a crisis. And this is the output from the last 4 quarters. And you can see the recession part is now our base case scenario. And this is a 6-month forecast. And so we think that by the middle of this year, the US it will be quite apparent that the US has finally entered a recession. And in addition, we do think that inflation has likely peaked. So when we look at a series of indicators, we are clearly seeing previously very high numbers starting to roll over. So here's a few examples. On the left-hand side, that's the price of core goods in America, clearly rolling over. Top right-hand chart, that's shipping costs out of China to Europe and US, again, clearly rolling over. And the bottom right-hand chart is used car prices in America, again, clearly rolling over. And therefore, because inflation is rolling over and we think that the US will enter a recession, we think the Fed may continue to hike a few more times this year, but will likely so-called pivot or turn back to rate cuts in the second half of this year. The chart on the left-hand side, on the top left-hand corner, that is our outlook for Fed policy. The blue line is where the Fed has been. That's all the 50 basis points, 75 basis points hikes you saw this year. The yellow line is what market is forecasting, and the dotted line is what JP Morgan is forecasting. So we think that they will probably take the short-term Federal Reserve rate to about 5%, keep it there for a little bit, and then once they realize, oops, inflation has already rolled over, US is entering a recession, unemployment is rising, they'll then begin cutting towards the tail end of this year. In the interest of time, I'm going to skip some of these slides. So what are we doing in the portfolio? Right now, US housing is quite expensive. It's quite unaffordable for many Americans. So what's happening is that more and more Americans, they don't have a choice, they have to rent instead of purchase a home. Because mortgage rates are at 20-year highs in America, housing prices have breached previous 2006 peaks. So rental demand for apartments is very strong in America. And there's a type of bond that is backed by property developers that develop properties that are just for rent. And so these guys are minting it right now because rents are going up, their costs are fixed. And so the value of their properties are going up quite a bit, and so the credit risk of these securities are quite solid. And so we have some of these securities in here. We also have some corporate bonds in here. And right now, we are targeting to produce a yield of around 8%, keeping the strategy investment grade, which we think is actually not a bad deal. Now, finally, all of you know that the fixed income market's performance was horrible. Yields rose a lot. But because yields have now risen back to an attractive level, the forward return for the bond market is now actually looking quite attractive. The risk return profile of many different fixed income sectors are now looking quite attractive. So what we're doing here, remember I said, when interest rates go up, price goes down. When interest rates go down, price goes up. So what we did was we did an exercise looking at different fixed income sectors. The blue line is a simulation of what happens to returns if yields go down by 1%. Now, if the reverse is the gray bar, what happens to returns if yields go up by 1%? So you can see the blue lines are clearly longer than the gray lines. And in addition, in some sectors, it's actually still positive, even when yields go up by 1% in that particular sector. Take, for example, US high yield, which is the fifth row from the bottom. If yields go up by 1%, you make almost 14% 1 year later. But if yields go down by 1%, you make 14%. If yields go up by 1%, you only make 5.5%. So the risk return for certain fixed income sectors have gotten very interesting, and we think 2023 is going to be a very interesting year and rewarding year for bond investors. So in summary, there are still risks out there. There are still some uncertainties out there. And so active management, staying fluid, is still going to be very important. So I'll leave you with the same advice I gave at the beginning of my speech, and that is, be water, my friends. Thank you very much.